You are listening to the South America Brief. I'm Camila Perez, your virtual information influencer, guiding you through market data trends and stories from the vibrant economies of Latin and South America. Hola, and welcome to the South America Brief. I'm Camila Perez, your market intelligence specialist for Latin America, speaking today from Mexico City. In this episode, we're diving into a topic that is shaping boardroom strategies and export decisions across the globe: the new U.S. trade policy under President Trump's second term, and what it means for Latin American economies. My insights today are based on a fresh discussion paper from the German Institute of Development and Sustainability, which looked closely at 5 countries: Argentina, Brazil, Chile, Colombia, and Mexico. For over a century, the United States was Latin America's main trade partner. That changed in 2023, when China took the lead. Today, the region's economies are tied into both the American and Chinese value chains, often as suppliers of commodities, raw materials, and intermediate goods. This integration creates structural exposure. Whenever tariffs rise or policies shift in Washington or Beijing, Latin American exporters feel the impact almost immediately. And under the current administration, with its talk of reciprocal tariffs and its openly protectionist stance, this exposure has become more acute than ever. Let's break it down country by country with some hard numbers. Argentina sends just under 10% of its exports to the United States, and less than 8% of its manufacturing goods. China takes about 10%, while over 40% of Argentina's exports go to Latin America itself, and there, almost 3/4 are manufactured goods. Argentina's dependence on the U.S. is therefore relatively limited. The main exposed products are crude oil, with nearly $4 billion in export value, aluminum, and hormones. Oil alone represents almost 6% of Argentina's exports, and while 36% of it goes to the U.S., more than half is already sold regionally. That gives Argentina flexibility to divert flows if tariffs rise. Brazil looks similar in scale. About 10% of its exports go to the US, but more than 30% head to China. Brazil's most exposed industries are pig iron, semi-finished steel, and aircraft. Aircraft are especially strategic. More than $2 billion in exports, 41% of which go to the US. Pig iron has a 73% US concentration. But the EU is an important alternative market, already absorbing nearly 1/4 of Brazilian aircraft exports, which may become more relevant if the Mercosur-EU deal progresses. Chile stands out with a slightly higher share. 15% of its exports go to the US. Almost 40% go to China. The US-bound products most at risk include salmon, grapes, silver, and petroleum derivatives. Fresh and frozen salmon fillets together represent over $3 billion in exports, with almost half going to the US. Grapes add another billion. Silver exports show a US concentration of nearly 50%. Altogether, around 6 to 7% of Chile's exports are highly exposed to US tariffs. Still, with copper dominating exports to China, Chile has a certain cushion. Colombia, however, is in a different position. Over 26% of its exports go to the United States. China takes less than 5%, while over 30% go to Latin America. But here is the key. Nearly half of Colombia's export basket is highly exposed to US tariffs. Oil alone represents almost 25% of Colombia's exports, with over 1/3 heading north. Coffee adds another 5%, with almost 40% going to the US. And flowers, roses, carnations, and others are heavily concentrated on the US market, often above 70%. These are not small figures. For example, crude oil exports to the US are worth over $12 billion. Coffee exports are worth almost $3 billion. Flowers contribute nearly $1 billion. The United States is Colombia's lifeline market, and tariffs here would be deeply disruptive. Now Mexico. Here the numbers are striking. More than 76% of Mexico's total exports and 78% of its manufacturing exports are directed to the United States. China takes barely 2%. Latin America absorbs only about 4%. This level of concentration is unique. Essentially, Mexico's economy is designed around the US market. Its top exposed industries include vehicles and vehicle parts, electronic appliances, medical instruments, oil, beer, and tomatoes. For example, wiring sets for cars and aircraft alone represent over $11 billion, with more than 90% going to the US. Beer exports add another $6 billion, again with over 90% shipped north. Tomatoes, more than $3 billion, with over 92% sold in the US. In total, dozens of Mexico's key export products rely overwhelmingly on access to the American market. That is both a strength and a vulnerability. But there's another angle: opportunities. The tariff conflict between the US and China is not just closing doors, it's also opening them. Brazil is poised to benefit most when Chinese tariffs hit American soybeans and oil. In 2023, Brazil already exported larger volumes of soybeans and oil to China than the US did. Argentina could also gain in cereals and meat. Chile might benefit in copper and wood pulp, and Mexico, because of its industrial base, has already become a winner in manufacturing. In 2023, Mexico overtook China as the largest exporter to the US. Of the 135 product categories where China sold more than $500 million to the US, Mexico already matches or competes in dozens. This shift, often described as friendshoring, is accelerating. For Mexico, tariffs on China mean opportunity, but tariffs on Mexico itself would be catastrophic. Here is the bigger lesson. Latin America is still highly commodity dependent when trading with the US and China. But within the region, the story is different. Intra-Latin American trade, though underdeveloped, is the main market for higher tech goods. Argentina sends more than 80% of its medium tech exports and nearly 3/4 of its high tech exports to regional partners. Colombia sends 72% of its medium tech and almost 60% of its high tech exports to the region. For Chile, the figures are 69% and 54%. Even Brazil, with its large global orientation, directs almost half of its medium tech exports to Latin America. Only Mexico is the exception, with its eyes almost entirely fixed on the US. This means that strengthening regional trade is not just about resilience, it's about upgrading. Regional partners buy more sophisticated goods. They are the market for Latin America's technology, not just its soybeans or copper. In an era of growing protectionism, regional integration could be the decisive factor for long-term growth. So what can we conclude? Mexico is by far the most exposed to US trade policy shifts, though also the most likely to profit from China's weakening position in the US. Argentina and Brazil have moderate risks, with strong buffers in commodities and alternative markets. Chile is diversified, but still sensitive in salmon and fruit. Colombia is vulnerable, with nearly half of its exports highly dependent on the United States. The US-China tariff conflict is reshaping global supply chains. For Latin America, it is both a test and an opportunity. The region stands at a crossroads, and the decisions taken now, especially in terms of regional integration and diversification, will determine whether it emerges stronger or more fragile. I'm Camila Perez, and this was your South America Brief Insight from infobrokerworld. If you are a business leader, an analyst, or an investor seeking to understand the evolving trade landscape in Latin America, I encourage you to explore the full report, which we have linked in the show notes. Thank you for listening, and I look forward to sharing more insights with you in our next episode. Thanks for tuning in to the South America Brief. For more details, links, and further insights, check out the show notes. By the way, I am 100% AI generated. My voice was created with 11 Labs, and I'm here to bring you curated knowledge with a human touch. This podcast is powered by infobrokerworld, your partner for market intelligence and custom research on Latin America. Until next time, stay informed, stay curious. Hasta luego.